Welcome to the Dough Roller Money Podcast. I'm your host, Rob Berger. Today in episode 339, I'm going to start answering some more questions that you all have sent in. For those that are members of the Facebook group, you know that I asked for your input. I asked for questions and topics that would be of interest to you and got a ton of comments. I'm looking at it now. So far, 72 comments and counting. And so I've got my work cut out for me, but that's okay. And a lot of great questions, and I will try to work through them, over the coming weeks and months and years and decades. We'll see. So today, got a great question from a listener named Aaron, and I picked his question first because it's actually something that I've been focusing on quite a lot for my own investment portfolio. And let me read you his question. He says, Rob, in DR podcast 332, and apparently this is at the 18-minute mark. He's very precise. You stated that you are, quote, less convinced that betting on value versus growth is the most sensible way to go, end quote. There wasn't a need in my portfolio to make that wager, which is effectively what you would be doing. Oh, I guess that was the rest of my quote. Then he says, can you explain why small cap value may not be the best bet? And that's a great question, and I will do my best to answer it in this episode. So some things to think about before we dive. Of course, I got numbers for you, and if you're watching this via video, in a minute you'll see some portfolios that I'm going to analyze. But not to worry, if you're listening, I'll walk through it all. But I kind of want to step back for a moment and just think about this from a conceptual standpoint in a couple of different ways. The first is, whenever I'm thinking about an investment decision like this, should I invest, any money in small caps? Should it be small cap value, small cap growth? I always want to ask myself, how important is this question? Of all the decisions I have to make about finances, is this one I'd better get right or I'm in big trouble? Or is this one that, it's not quite that important? And I certainly put this in the not quite important category. That is to say, I can think of dozens of things that will influence your ability to, let's say, achieve financial freedom or retire on time or whatever your goals may be, beyond whether you put money in small cap value, such as, how much you save to begin with. And there I like to think of it not in absolute terms, say $1,000 a month, for example, but rather in what percentage of your income are you saving. I think that's the right way to think about how much you're saving is the percentage of your income. But that's going to be far more important than whether you invest in small cap, right? Your stock bond allocation, far more important. How much debt you have, and if you'll be debt-free, say when you retire, for example, far more important. Maintaining your health, which may seem a little far afield from an investment portfolio, but it turns out that not maintaining your health, and of course some things are beyond our control, but for those things that we can control, it drives right to the bottom line. I mean, health can either help you financially or hurt you, right? Again, some things are out of our control, but the point I'm trying to make is I want to put the question in some context. It's certainly an important question. It's by no means irrelevant, and I think we can learn a lot by examining the question, which we're doing today. But I wouldn't lose any sleep over it, I guess is really what I'm saying. And if you want to invest, at the end of the day, if you want to invest in small cap value, you certainly won't get an objection from me. And if you don't want to invest in small cap value, same. That's the first thing. The second thing is, it gives us an opportunity to think about asset classes and the way in which the industry divides and subdivides, in this case, stocks. And we could step back for a moment and say, well, wait a minute. Why do we even care about the size of the company? Why is that even important? Small cap versus mid cap versus large cap. And why do we care about value versus growth? And if you're new to the show and you're like, I'm not quite sure what these terms mean, real simple. Small cap is just short for small capitalization, medium capitalization, large capitalization. And all that means is the size of the company as measured by the value of its outstanding stock, right? And there's no official amount that qualifies you for, say, a large cap status. That can vary depending on the mutual fund and their goals. But generally, large caps are going to be worth, hundreds of billions of dollars. For example, Apple, which is now, of course, worth, a couple trillion. Small cap, they're still big by, our standards, I suppose. But, a $5 billion publicly traded company is pretty small. So that's all that I mean by small cap, large cap, and so on. And value versus growth, there's different ways you can subdivide stocks between value and growth. But conceptually, what it means is this. A growth company is one that's growing its revenues, growing its profit, growing its cash flows faster than the average company. And a value company, of course, by definition, is not doing that, but its stock price is quote unquote low relative to its earnings. So in today's market, Tesla and Amazon would be growth companies, and most banks, maybe all of the banks, as far as I know, would be a value company. So growth companies tend to be the sexy companies that everyone likes to talk about, if you find any of this sexy. And value companies are the ones that you probably think your parents might invest in, or grandparents, depending on how old you are, or old folks like me. I just invested in a bank. But I do own Apple, so I got that going for me. So anyway, we divide stocks, or the industry does, between, among other things, growth versus value and the size of the company. But does that make sense? Why do we do that? Now, one answer could be, well, when we look at history and we see that we compare, let's just say, small cap stocks with large cap stocks, we see a difference in performance. And in fact, I can show you that very quickly for those watching, but no worries, I will talk my way through this if I can start typing. That's the problem. Here we go. So, still didn't get it right, but I finally got to the website. I'm at Portfolio Visualizer. And that's interesting. Maybe if I log in. All right. Sorry for that interruption. We are at the Portfolio Visualizer. We're looking at performance from 1972 to 2020. 1972 is as far back as it goes. We're going to assume an initial investment of $10,000 and that we contribute a fixed amount every year of $1,000 that is adjusted for inflation, right? And we can compare different portfolios. So let's compare two. One will be just U.S. large cap, and that'll be 100% of the portfolio. And the second one will be U.S. small cap. And the question is, over the last, 50 years almost, let's see, in 72, what happened? I think Nixon and Spiro Agnew defeated McGovern and Sergeant Shriver, I think, right? I think that's right. It was a long time ago. Anyway, in 1972, a long time ago, so we're looking at almost 50 years. If we analyze the portfolios, there's a big difference. So the small cap, which is portfolio 2 for those watching the video, the final balance is $5.4 million. By the way, if the thought of turning 10,000 plus 1,000 a year into a number like that surprises you, welcome to the power of compounding in time. Portfolio 1, large cap, big difference, 14.1%. One of the interesting things, and this is why I like looking at numbers and data, if you look at this CAGR, compound annual growth rate, if I were to just show you those two numbers, and for those listening, 13.14 for the large cap, 13.8 for the small cap, I mean, yeah, we all know that 13.8 is more than 13.14, but it's not as if the difference seems all that significant. And yet, over 50 years, which certainly if you're investing in your 20s or 30s, you're going to keep investing in retirement. You could be investing for 50 years. It made a huge difference with the outcome, right? 5.4 million versus 4.1. And you're talking what, 66 basis points, if I've done the math right? Not a seemingly huge difference, but over the long term, it's ginormous, which is one of the reasons that I stress the importance of keeping fees low, particularly advisor fees and really expensive, actively managed funds. But in any event, back to our point, you can see there's a big difference. And so some would say, and I don't disagree with this, small cap stocks, companies, perform differently than large cap. As we can see, at least over the last 50 years, they earn more. And if we looked at their volatility, and there's different ways to look at volatility, but we would find that they tend to be more volatile. The swings up and down tend to be worse for small companies. And in fact, if we look at what's called the standard deviation, which is one measure of volatility, sure enough, the standard deviation for small cap is about 19.5%. Standard deviation for large cap, just over 15. So it's kind of a perfect opportunity to use small caps to diversify a portfolio because, yes, they're much more volatile, but it's going to be part of a larger portfolio. I don't think most of you are going to put 100% of your investments in small cap. And so, yes, they're volatile, but really what we care about at the end of the day is not the volatility of any one asset class, but rather the volatility of the portfolio overall, right? And now, having said all of that, though, you could kind of go off the rails with this. So, for example, let's imagine I could look at all of the companies in the S&P 500 that have been in business at least, 10 years. And I divided them, I grouped them, but I didn't group them by their size. I didn't group them by value versus growth. But what I did was I went back into the history books and I found out what day of the week each company was first incorporated. Monday, Tuesday, Wednesday, Thursday, or Friday. I don't know if you can be incorporated on a weekend. We'll assume no. And I divided them. So I got my Monday companies, I got my Tuesday companies, all the way through to my Friday companies. And I did the same analysis. Now, of course, I don't have this data, but I would guarantee you that if we went through the same analysis, but using those groupings rather than small cap and large cap, we would find one day of the week outperformed all the others. It probably had higher volatility too. But there was just one day that just outshined them all. Would we think that that is a good asset class? I mean, I've said about it the exact same thing I've just said about small cap versus large cap. What's the difference? Well, of course, I think there's a couple differences, right? It's sort of obvious. One is we can at least conceptually understand why a small cap might outperform long term because it's riskier, it's more volatile. But what I really mean by that is folks require a greater expected return for taking the risk of investing in a company that doesn't have the same history, same capital, same exposure to the market that large companies do, right? So it makes common sense why small caps would outperform, and why that's important is because what we really care about is not what's happened in the past. What we really care about is what's going to happen in the future. And if we can make some sense out of what's happened in the past and understand it and say, okay, I don't think that's going to change. I think investors are going to continue to sort of expect higher returns and the extra volatility that come with small caps. That's just not a fluke. It's not just an arbitrary, this is just how it turned out. It makes some sense. Whereas on the days of the week, that doesn't really make any sense, right? I mean, there's nothing special about incorporating your company on Tuesday. So that just doesn't make a lot of sense. But then it raises the question, well, and this gets to small cap value versus growth. Does history tell us that value, in fact, really does outperform growth? I mean, that seems to be the fundamental question. Before we could even begin to ask, well, why, if it does outperform, why? And can we expect it to continue in the future, right? And that really gets to the heart of Aaron's question and will help me explain my own views on this at the moment. And so let's look at it. So what I did, I created another backtest. For those watching, you see it on the screen now. And I created 3 portfolios. One was 100% small cap value. One was 100% small cap growth. and one was 50-50 of each. And I'm actually going to change this now. This goes, make a quick change to this just to make it a little easier to understand. All right, so we've got, again, 100% small cap value, 100% small cap growth, and then just a blend of the two, 50-50 each, from 1972 to 2020, $10,000 initial investment, annual contributions of $1,000, adjusted for inflation. So any idea what this is going to generate? Just think about it, take a guess. We can go back to the portfolios we looked at before, large cap versus small cap. They came out at 5.4 and 4 million. What are these going to do that are 100% small cap, some value, some growth, and a little of both? Well, here we go. We analyze the portfolio, and here's what we see. Small cap value, and I already see a mistake, so let me fix that. Try that again. There we go. Small cap value trounced the other two. Small cap value, if you'd put all your money in small cap value in 1972, you either did not or you did vote for Nixon. That doesn't really matter because you put 10 grand in a small cap value fund, you contributed $1,000 a month, and here you are in 2020, you're worth almost 10 million bucks, 9.7 million, almost 9.8. If you went with small cap growth, you're only worth 5 million. I mean, not a bad number, but it's almost half. And of course, the blend, as we would expect, is somewhere in the middle, like right down the line, right? That's about 7.5 million. Now, at this point, you're saying, Rob, I don't quite get what you're saying, because if you trust these numbers, haven't you just told us we should all run out and invest in small cap value? Well, I think if we were living in 1972 and we knew what the future was going to be, absolutely invest in small cap value. A couple of the questions we always want to ask and think about when someone's presenting us with back-tested data is, one, the time period. Okay, I've picked 1972. It's kind of arbitrary. The only reason I picked it was because that's how far back Portfolio Visualizer goes. That may or may not be a good reason to pick it, but that's why I picked it. What if we pick a different number? I mean, we can't go back in time with this tool, but what if we picked, in the 80s or the 90s? Would that change the results? That's sort of the question that we need to answer. And so let's do that. So instead of 1972, we'll just jump forward 10 years, 1982. We analyze it. So when we look at the results, they're kind of surprising. And one of the things I'd assumed when I ran this was that the small cap, the blend, 50% value, 50% growth, would always be between the 100% value and the 100% growth fund. But of course, that's not the case. As for those watching can see, actually the blend between value and growth wins at 1.6 million. The small cap value comes in second at 1.5, almost 1.6 million. And small cap growth comes in at just under 1.5 million. And here's the thing to keep in mind. Whenever you are contributing to or taking out of a portfolio, the sequence of returns matter. What return you get each year matters. If you just invest a lump sum and let it sit there for some period of time, 10 years, 50 years, doesn't matter. The order of returns don't matter. You could just look at the average return, annual return, and apply it, and you'd get the same outcome. But when you start to either contribute money or take out money, the order of returns starts to matter. We see that most often in retirement, and that's where we get this idea of a sequence of returns risk. The idea that if returns are really bad in your first, say, 10 to 15 years of retirement, if you're following something like the 4% rule, it can really cause a lot of trouble for you. The same, by the way, would be true with inflation. If inflation is really high in the first few years of retirement, that could cause a problem for you. But it's because you're pulling money out of your investments every year. If you just left a lump sum in there and you just left it for a long period of time, what order the returns were in wouldn't matter at all. Now, in this case, remember, we're contributing $1,000 a year to this portfolio. So the sequence of returns matter. And between value and growth, as they're each moving somewhat independently of one another, in this case, those sequence of returns caused I'll call it the balanced portfolio, to actually win. Now, there could be other cases. In fact, I'll show you one. I'm going to guess if we go, instead of 1982, if we start, I'm going to guess 2000. I'm going to guess growth is going to win this. But I could be wrong. We'll see. I'm wrong many times. No, growth wins this. So from 2000 to 2020, last 2 decades, again, the numbers are much smaller because the time period is shorter, but growth finishes at 125,000. The blend between the two, 118,000, and small cap value comes in last, 105,000. And the reason I guessed that is because particularly over the last dozen years or so, growth generally is clobbered value. That's just a reality. So it was sort of through this kind of analysis where I came to conclude that, one, I really do like some small cap exposure in my portfolio, but I'm not sure that it makes sense to bet on value versus growth. That, yes, over some periods of time, value will outperform growth, but for long periods of time, growth will outperform value. And there's no way for me to really know which one is going to do best over at least my investing time horizon. And in fact, the thing about growth and value is that if you go all the way back to 1972, where we started, and I'll jump back there so folks watching the video can see this chart. It's a little hard to tell here, and in fact, let me get rid of portfolio 3, which is the mix, and rerun this just to show value and growth. What you see is that in the early years, say the first decade starting in 1972, growth was on a tear and it just clobbered, value was on a tear and clobbered growth. But then what happened over time was that they sort of evened out. And in the last 10 years, growth has beat value, right? So that's the problem, is that you can have a great 10 years, and then after that, not much difference at all. But still, by fast forwarding a total of 40 or 50 years, it still looks like value's clobbering growth, when the reality is it basically clobbered growth for about 10 years. And in fact, if we could go forward, say 40 years, we might see that, say, from 2010 to 2050, growth clobbered value, but only because it clobbered value in the first decade. Does that make sense? I hope it does. You can see it in the graph if you're watching the video, because after you get past a certain point, the difference, not only does it not get wider between value and growth, in many cases it narrows, and it's of course narrowed a lot more recently. And in fact, if we were to just look at the first 10 years, we could see just how much value exceeded growth during that time period. So all of this came together for me to say, you know what, I'm not sure that value does beat growth, at least over any relevant time horizon. It may, as it did, say, in the 70s and early 80s. Sometimes it won't, as in the last decade. And so I just wasn't willing to wager on value versus growth, even though I have in the past, and for many years owned a small cap value fund. And primarily the reason I did was because I read a lot of things that said small cap value outperforms. And I'm sure if I went back into the Dough Roller archives or the Forbes archives or this podcast, I probably suggested small cap value. But this is one of the reasons we never stop learning, right? Now, again, if you still want to stick with small cap value, you'll get no objection from me. I think you'll do just fine. I do think small cap exposure is important. And there's even a fair amount of analysis that says when we go into a bear market, like we kind of went into one this year, I suppose, and we recovered, but that right now is actually a good time to invest in small cap value. That if you look at history, when it has performed well relative to, say, growth, it's performed well in circumstances like this. And that kind of makes sense because, you'll see one or the other outperform for some period of time, and then it reverses and goes back. And that's just sort of the nature of the beast. And it's part of the reality of investing in sort of a diversified portfolio, that there's always going to be some asset class out there that outperforms whatever you and I are trying to do, no matter what we pick. And that's just sort of the reality. And it's kind of, you got to be careful of the fear of missing out. And I think if you start, the real problem becomes if you start chasing those returns. So like now you say, oh, well, growth has done so well the last 10 years. I'm piling everything into growth. And a lot of people do that just as growth goes out of fashion and value comes in. So the biggest takeaway, I think, in answering Aaron's question is pick something that you're going to stick with. That's more important than value versus growth versus a blend. Pick something you're going to stick with and then stick with it. So I hope this video makes some sense, and you kind of get a better sense as to where I am on the value versus growth. I will tell you, for individual stocks, I tend to prefer value companies. I do own Apple, which is not a value company, but I bought it when it was a value company, and it's just done really well. I bought Bank of America not long ago. That's definitely a value company. I own Berkshire, which is kind of like right in the middle, I would say, of the value growth line. So, but for my portfolio of index funds, which is 85% of our portfolio, I've just sort of moved away from the focus of value versus growth. I haven't moved towards growth, even though growth has done really well. And that's a perfect example where I could look at, boy, if I'd invested in small cap growth and large cap growth 10 years ago, I'd have more money. But those are the kinds of predictions that I'm not able to make as well. I'm still insisting that interest rates will go up in 2010. So I just don't try to predict that. So Aaron, hope that's helpful. If you are listening and you haven't joined the Facebook group, you can do that. Just go to doughroller.net // Facebook group. Find the post where I asked about, questions and topics, and ask a question or topic. I will get to them. It may take me a while, but I'm going to do it. And hope you found this helpful. Hope you're staying safe. And until next time, remember, the best thing money can buy is financial freedom.